Coming up on today's show, should you buy this dip or wait? What happens if we don't get a Santa Claus rally? The warning signs in the stock market we should all be paying attention to, and will we see an inflation resurgence? We've got a lot to talk about. Let's roll the tape. Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500, and stocks fell on Monday as all three major indices continued their declines in the final week of the year in what has been otherwise an extremely strong 2024, and we couldn't even claim bad breath today because everything was red, including the mega caps. Tesla down 2.27%, Amazon fell 0.64%, Apple and Microsoft down about 0.9%, semiconductors fell, Google and Meta were both red. So it was selling, broad-based selling across the market, except in energy, excluding Exxon and Chevron. And then we also saw Nvidia, which was up 1.48%, but it was selling across the board. Every single sector was red today, except for energy, which was down 0.3%. And we're going to explain why a little later on in the video. But the SPY fell 0.66%, and there wasn't really much of a trend with regards to sectors. You can see the best performing sectors, although still red, varied from defensives to cyclicals to rate sensitives, and vice versa here at the bottom with materials, defensives, healthcare, cyclicals with discretionary. The trend we did see though was that we actually put in a bottom very early on in the morning. Around 10:30, we had a sharp decline, and then markets since have made higher highs, higher lows, although still red for the day overall, with small caps, large caps, and mid caps all participating in the downside, with mid cap value and small cap value outperforming the broad market. But all in all, losses across the board, and it wasn't just the US. Globally, we saw what I believe to be profit taking across the board here in the US, in Europe, in most of Asia, as well as Australasia, because we've had a fantastic year. If we actually look at yields at the dollar and what we saw today, that further proves my point of profit taking, but we'll talk about that when we get to the chart. Now, the reason why energy was positive in a sea of red today actually had to do with natural gas. Natural gas prices surged, that biggest jump in over 2 years due to colder temperatures across the US and Europe. February futures contracts were up like 22% for natural gas. The United States Natural Gas Fund was up 14%, up nearly 20% at the high of the day. Very bullish price action, and that helped energy soar in a sea of red. In other market movers, we saw stuff like Boeing. This was absolutely crazy. Boeing fell 1.93% today, but was down nearly 3% at the trough of the day after one of its jets skidded off a runway in South Korea, killing 179 out of the 181 passengers on board. South Korea is inspecting all 737-800 aircrafts operated in the country, and this was absolutely crazy. This was a devastating crash, the worst airline disaster in South Korea ever, and other airline stocks wavered in the wake of this crash. United Airlines fell 0.9%, Delta Airlines slipped 0.3%. Very sad to see this type of stuff. I would love to see what the investigation concludes out of all of this. Was it just maybe the runway that was at fault, or was it specific gear, the servicing? Was it Boeing itself? I really want to see what the outcome of this is. Now, the other green stock here today was actually Nvidia. Nvidia was up 1.67%, bucking the overall red trend of the market, but it was red pre-market, and for most of the day it actually reversed direction following a report from The Information that its customers, ByteDance, plans to spend $7 billion on its AI chips in 2025 despite US export restrictions on goods in China. Now, despite the red price action we got in the market today, we actually did get very positive economic data. We got very thin data, but we got pending home sales month over month and year over year. And that's essentially housing contract activity, and it picked up in a very big way in November as buyers pretty much shrugged off elevated mortgage rates and looked to take advantage of higher inventory levels. The pending home sale index, which tracks contracts signed on existing homes, rose 2.2% against the consensus estimate of 0.7%. This is the fourth straight month of gains. Pending home sales are up 6.9% compared to November in 2023, and consumers have recalibrated expectations regarding mortgage rates and are just taking advantage of more available inventory, which just means lower home prices. And if prices come down and mortgage rates stay elevated, that's the equilibrium you want to see in the market, demand and supply at work. However, despite this good economic data and Nvidia's rally, the market overall was pretty sour today. We had more decliners than advances, the fourth day in a row, 3,875 decliners against only 2,400 advances, and a lot of these decliners were in the S&P 500, which is 80% of the US market. All in all, guys, longer term averages continue to be above the 50% mark, but we're getting eerily close here in the 150-day moving average to the 50% level. So one more red day and we're probably going to see this number below the 50% mark, and that's not exactly what you want to see, especially when we've lost the 5-day, 20-day, 50-day and 100-day moving averages. So we've lost the shorter term and medium term trends. The only thing holding us together is these longer term trends, and if we start losing these, algos could kick in, market momentum could kick in, and we could see a serious pullback here to start off January. Now, I was really thinking such a pullback would come near the inauguration. However, the markets don't really work on a timeline per se, and that pullback could start as soon as next week, especially if we lose some of these longer term moving averages, because the algos really do calibrate themselves to the 100-day, 20-day, as well as 200-day. We've already lost both of these, the 20-day and the 100-day. If we lose the 200-day, things can really get ugly in the market. But let's hop on the charts. Now, guys, before we get started, I do want to make note that I am actually recording this before the market closes, both the intro section and this chart section, and that's because it's New Year's Eve. I got plans, so I'm sorry if the market data doesn't match up accordingly. However, we could see that equities were red across the board, the S&P 500, the Nasdaq 100, the IWM actually outperforming relatively speaking, and we have actually seen some downside outperformance in the IWM as well as the RSP, relatively speaking, to these larger cap names. And that's because we actually saw yields fall today, the 10-year yield, right, the 2-year yield and the 30-year yield. And that was despite stronger than expected economic data. The dollar was largely flat. And I do think, guys, we are nearing a topping process in both the 10-year yield and the dollar. Probably over the next month, we're going to see some consolidations in the highs here with the dollar. And then we're probably going to see some downside momentum, probably getting back to this 105, 104 level. That's what I think. And that's actually going to coincide with yields, the 10-year yield actually pulling back as well, probably to this 4.2% level. And that's going to be a huge boon for equities, particularly the RSP and the IWM. And we actually do see this in Trump's last campaign. We saw the dollar rally, and then we saw it slowly move down into the first term of his presidency. Now, there was actually nowhere safe today apart from crude and natural gas, which was up 1.17%, WTI and natural gas. This is the spot index up 12.57%, but silver fell 1.14%, gold fell half a percentage point, Bitcoin was up 0.85%, but most people only have a 1% or no allocation to Bitcoin. However, bonds did gain as a result of yields falling. And so, if you were in bonds, you probably did outperform the market today. But to be honest, most people are in equities, especially after the year we've had. And if you look at the S&P 500, as well as the other major indices, we're at a pivotal level, okay? You could see right here that, yes, we got into positive gamma last week. However, we moved back into negative gamma, but we saw huge buying activity from the lows. So still negative on the day, don't get me wrong, right? But this is immense buying activity right at the put support at this low. And if we continue to move up from here onward and upward back into positive gamma, what we would be doing is actually forming a higher low right here relative to this low right here. That's positive at the put support. That would be a real tailwind for equities into the start of January. If this does prove to be a higher low and we break this high, that would just signal trend continuation. And then we could just say that this was really just thin volume and some profit taking here at year end. A lot of this does scream profit taking, as well as a little bit of anxiety after the Jerome Powell hawkish pause. But all in all, I think things still look largely largely constructive for equities, especially when you look at the charts. And the S&P 500 has still not been able to go ahead and fill the Trump election gap arc. So that's really constructive, and the market's really holding this key level here, being the 58.60 level. We have to put support. What we really want to see is a very, very solid close and consolidation here in the positive gamma area. That would mean we probably go onward and upward in the S&P 500. However, if we cannot retake the positive gamma line and we do consolidate below it, it probably means more downside. And then we would need to look at what happens to the put support. Does it move lower, or do we continue to consolidate at this area right here and then look for the next move higher or lower? All in all, things looking largely constructive, especially with the wick we saw right here. That's a huge, huge wick at the put support zone. Very, very constructive. As this continue to fall through and we consolidated below, that would be ugly. Also, the put support didn't move lower at all. Normally, when you see this type of price action, the put support moves lower. It didn't, and that means this level is holding, and it actually has held this entire time. You think it would have moved lower here, here, or here? It did not. It stayed at this exact position. This was the exact position after the Trump gap up where the put support repositioned itself. So a very, very solid area here. And you can see this used to be resistance. That resistance has now turned into support on multiple occasions, building a very strong base of support right here. And this is probably where you want to buy for a continuation into 2025. However, if we do break this level and I think close the gap here in the S&P 500, right, that would definitely signal more downside. However, what we're doing right now in the market is buying all dips at the 58.60 level. The Nasdaq 100, very similar situation. Now we did get below the put support, right? However, we did buy the dips. Bulls did buy the dip. We're consolidating in the put support zone at the put support line. And what the bulls need to do now is continue to move us higher to this gamma flip. If we keep seeing price action at this level below the put support line is going to move lower, and that probably means lower price action for the Nasdaq 100. However, this is looking like a higher low relative to this, and all in all, we just see higher lows, right, and higher highs, except for this high right here, which does signal a break of trend. However, if we put in a higher low and continue to move up, break this high, and then go retake those all-time highs, that would be constructive, all things considered. But again, guys, you want to look at the overall trend. It's been a great year. It seems like a little bit of profit taking here at the top, selling some of your winners, selling some of your losers. Such goes the market at the end of the year. All in all, if you missed the rally this year and you're looking for 2025, here at the Nasdaq 100, the put support, the S&P 500, this is where you should start thinking about getting long for the new year. And then looking at the RTY, very similar situation. All of these indices are pretty much at their lows, at their put support. And yeah, again, we're holding these levels. These are absolutely critical levels. And this is sort of where we gapped up after the Trump trade. This is exactly what you want to see. These levels holding right here. And I would probably be adding into the names you like at these levels, because some of these stocks, stuff like ASML, right? ASML was down like 2% today. It was a pretty ugly day. So, start looking at stocks that you may like, stuff like ASML, stuff like PayPal, stuff like Paycom, stuff like Google. Look at those names and you really want to be adding to that, right? Look at the Nasdaq 100 down 1% here today. If you think mega caps are going to grow their earnings 22% in 2025, this is where you want to be adding, because in that instance, right, we will go ahead and take out the all-time highs. So all in all, guys, I remain constructively bullish on equities. I do think we're going to go higher into 2025. I do think we are going to see a little bit of a pullback to start the year off. We could be already in the early innings of this pullback. I really thought we are going to see that pullback circa the inauguration in the first quarter. However, we could have brought forward the gains of the Santa rally, and now we're bringing forward the pullback of the inauguration. So maybe if we do see continued downside in the S&P 500, we actually buy the inauguration, not necessarily sell it, but that would mean we probably do go lower. As it is right now, the consolidation we're seeing at these levels of the Nasdaq 100, the S&P 500, and the Russell 2000, to me, this is signaling that we actually go ahead and buy this dip, because a lot of these indices, stuff like the Nasdaq 100, stuff like the RTY, down 10% from its highs, that's actually a correction. If we actually take a measured move for the Nasdaq 100 from its highs to where we are right now, that's a 4.29% pullback, right? That's about the standard correction we typically have seen this year. And I still think, yeah, if you want to buy the dip right here, if we do move lower, you then probably want to buy the next 5% move lower, because that's probably as low as we're going to go considering the strength we've seen in this bull market. I'm thinking this could either bounce right here and we move higher, but if we do pull back, it's about another 5% down from here. So all in all, you do always want to buy every 5% pullback. Things not looking too great in the near term. I'm still constructive on equities for the next year. Don't get me wrong. We want to buy all of the pullbacks we do get, but do be aware that we can actually see a little bit of volatility, especially if we break the put support right here. So get capital ready, guys. Start nibbling at certain stocks and indices you like. If we do go lower, be prepared to dollar cost average, because we are entering a volatile period. We may have pulled gains forward and we may have pulled a pullback forward as well, and we could be seeing that right now. However, this is still an opportunity to buy the dip. I do think 2025 is going to be a great year nonetheless. And diving into sentiment, guys, this is the percentage of respondents expecting stock prices to rise over the next year, and things are looking bullish. This is a strong sign of optimism. This goes back to the 90s, and we are seeing sentiment even above what we saw in the tech boom. And historically speaking, elevated levels of sentiment like this often align with bullish trends, as confidence fuels buying momentum and market participation. And I think the big reason why sentiment is so bullish has to do with something like the Santa Claus rally, which is the last 5 trading days of the year and the first 2 of the new year. And generally, we expect returns of 1.36 and 1.35% respectively, with an 87% win ratio. Now, the reason why this is such a great parameter for the year ahead, because when we look at everything from 1950 to 2023, right, a huge set of data, a positive Santa Claus rally is normally indicative of above average returns for the new year. You could see 10.4% after we've had a positive Santa Claus rally versus the average year of 9.3%. And when we have a negative Santa Claus rally, a 5% return. We also see the percentage of time stocks are higher in the year is also the highest when we've had a positive Santa Claus rally. So we do want to see positive seasonals in this time period, because it does bode well for outsized returns in the new year. And looking at the fundamental picture, assuming we get a positive Santa Claus rally, with fundamentals where they are right now, we could see another blockbuster year. We may not get a 30% return in the Nasdaq, but anytime we get double digits or more, that's a good thing. And if you say S&P 500 is fairly valued right now at 22 times, especially when you adjust for return on equity metrics, generally speaking, what happens is stocks will return what their earnings growth will be, and S&P 500 is expected to grow earnings by 15%, so that is the return you can expect. Now, for value companies or the Russell 2000, we're looking at 57% earnings growth for 2025. Absolutely crazy. And if you are looking for outsized returns, the Russell 2000 is the place where you want to be. So pretty much value stocks. And when you look at valuations of value stocks, they are trading at historical discounts to their long-term average versus growth stocks. You can see that this is value versus growth, and pretty much the lower this goes, value is cheaper relative to growth. The higher it is, growth is cheaper relative to value. And besides what we saw here in 2020, 2021 with the COVID bubble and the 2000 tech bubble, value stocks are trading at the cheapest valuation pretty much ever, trading at a 16 times forward versus 28 times in growth, but both are still above their long-term historical average, relatively speaking. And again, assuming value stocks like the Russell 2000 go out and produce 57% in earnings growth with valuations where they are right now, and the 10-year yield right now between the 4.5% to 5% range, you could see returns greater than growth stocks, relatively speaking. Now, all of these things do need to come together, but if they do, we could definitely see alpha in value stocks, and it's definitely a place you want to be allocated. Small caps, small cap quality, you want to be in those names. However, there are risks, guys, and at the end of the day, the percentage of unprofitable companies, especially in small caps, is here at 41%. So there are risks to that, and that could affect the overall earnings picture. And if rates do go above the 5% mark, that could really impact these companies, and that's why you want to have an allocation to large caps as well as mid caps. But at the end of the day, everything comes down to the macro, because if the macro environment stays robust, equities will do very well and we will hit those earnings growth targets. Now, when we actually look at the macro, guys, something we've seen this holiday season, MasterCard released their Spending Pulse report and they saw spending over this holiday period grow by 6.7%. Very, very robust. Consumers splurged on apparel, jewelry, and electronics for gifts. And the MasterCard CEO told Reuters that spending rose even when prices were higher due to inflation. He noted that the last 5 days of the holiday season accounted for 10% of all spending, showing a lot of strength in the end. So, guys, Q4 earnings season for discretionary stocks, staple stocks, financials, maybe even tech stocks should be really good, driven by a robust consumer. And another barometer for the consumer is like box office grosses. Now, in 2024 year to date, we are actually trailing 2023, but we should see a number of titles release post-Christmas into the new year, and that should actually surpass the 2023 level. We actually beat the 2022, 21, and 2020 level, but still trailing the huge number we saw pre-pandemic. Nonetheless, this shows people are willing to spend on experiences like movies, and it shows resilience in discretionary spending and reflects confidence in the macro environment. This is a bullish indicator for the broader economy. Now, a big narrative going into 2025 on the macro side will be the consumer and inflation, because that will determine the path of rates. Now, I'm still in the camp we are going to see inflation continue its trend to the 2% level on the back of shelter in falling, because when you look at alternative measures for new lease growth, they are virtually unchanged, now sitting at 0%. When you look at measures that other than what the Fed uses, rent inflation is basically zero. And in some instances, like CoStar and Yardi, we are seeing deflation in rent growth. And these are lagging indicators, so that should make its way into the CPI and PCI reports, particularly in Q1 and Q2 of 2025. And if we could continue to see cooler inflation moving towards the 2% target, stocks will rally on the back of that. And the reason why this is so important, when we see basically 0% of rent inflation, particularly as they do lag, that's because inflation, CPI, 44% of CPI is housing. And if we are seeing zero inflation and in some measures deflation, that's going to bode really well for inflation cooling, particularly in the new year. And so we'll see how that pans out. Looking at data for the rest of the week, there isn't much of anything tomorrow. The only big data is like jobless claims on Thursday and then the ISM manufacturing numbers on Friday, and nothing on the earnings front. We just have RGP and Lifecore Biomedical, and that's pretty much it for the week. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.